Hello everybody, welcome to the Trading with Ashley show. Today's video is going to be incredible for those of you that want to learn a little bit more about IV and IV Crush and how it works. It's actually very instrumental in the trades that I take, and it has allowed me to outperform the S&P quarter after quarter. And I use it a lot in earnings. In fact, I used it yesterday with that $1 million trade that I made on Palantir. And it was so wonderful to wake up this morning and to see that something that I had received $13,000 in premium for taking the trade, that it had whittled down to as little as $500 overnight. And that had a lot to do with price action, but it did have something to do with IV as well. And so the reason I like to explain all of this to you is because if you are an option buyer, IV Crush can literally crush your account. But if you're an option seller, you get to take advantage of the elevated IV. And then when IV Crush happens, you're the benefactor of that. So I'm going to show you real examples. I'm going to show you how to actually go and look at what the average IV is on a stock. And then you can notice when it's elevated for something like earnings. And then I'm going to show you how you can determine how much the option you sold will be worth after earnings once IV normalizes and comes down. But before we get into all that incredible detail, what I wanted to announce to all of you is that I am teaming up with another influencer who I really respect. I love his channel. I have been watching it for years. His name is Keenan Grace, and we are collaborating together to bring you a very specialized workshop that is going to help you learn how to take entries and exits on trades. And me, for my part, I am going to be teaching you how you can effectively trade any ticker symbol, regardless of your account size. So if you want, with the strategies I'm going to teach you, you could trade Meta, you could trade the NASDAQ, the SPY, and Netflix, anything. I'm going to teach you all of the details on how I select what strike prices to use for put credit spreads, if that's something that interests you. What if 2 hours of focused learning could finally take the guesswork out of trading? Keenan and I are hosting a live 2-hour options workshop to show you the exact strategies we use to trade the markets with consistency and confidence. I will be teaching you how to build winning credit spreads so you can grow your account without being limited to just a few ticker symbols with low strike prices.
And I'll show you how to time your entries like a pro, spot clean setups, read multiple time frames, and I'll teach you how to use stop losses in a way that actually protects your gains.
It's all happening Saturday, August the 9th at 3 p.m. PST, 6 p.m. EST, and spots are limited.
Click the link to lock in your seat. Thank us later when your trading starts making sense and starts making money.
Your future self will thank you. Now, if you're interested in this, it is a very reasonable price point, so it will go fast, and we do have limited spots. I am going to leave the link in the description for you to go ahead and sign up for that webinar. It's going to be this Saturday evening. I can't wait to spend time with you. Before we jump into the computer, let's talk for a second about IV and IV Crush and what it even means. So you know I like to use fun analogies. So the one I decided to use for this has to do with concert tickets. And so if you look at an option, let's say you're going to sell an option. A&D is having earnings today. They actually just reported, and there was elevated IV if you were going to sell an option. And the option had elevated IV because nobody knew what earnings would behold. They didn't know if it would make the stock go up or down, if earnings were going to be good or bad. And that big question mark on the outcome elevates the IV. It's just like if you had a concert ticket and you were wanting to go to the concert. It has a value to it. But before that concert, you can resell that ticket, usually for a really high amount. But once the concert actually starts, then the ticket starts to rapidly lose value, even before the main entertainer has come on stage. And the reason is, all of the hype, all of the excitement starts to die down once the event actually starts. And so it's no different with earnings. Once the outcome is known, then if you sold a put on an option, then you got that elevated premium for selling the put. And then after the earnings event is over and everyone fully understands what the future holds for this stock, then something called IV crush takes place, and the value of that option that you just sold maybe a day before, it comes tumbling down. Now, if you're an option buyer, you have experienced this, and it's really tough. It's really hard to make money when you're doing a directional bet over earnings. So what I like to do is I like to be the seller of the option. And the reason that the IV goes up so much on put options when you are working over earnings, it has to do with the fear factor. So let's assume we're going to work with AMD. Let's assume you have a big stake in AMD and you want to protect your portfolio. Well, then what you might do is go and purchase a put option. That put option that you're purchasing, it gives you the right to sell your AMD stock at whatever strike price you purchased. Even if AMD tanks to zero, you have something in your hand, it's insurance, and you are able to use that to sell your AMD stock. Well, I am the one that is selling that put. I'm the one that is putting up the money to buy your stock if it tanks. Now, I don't have enough exposure to AMD, so I, on the other hand, would be really happy to pick it up at a very fair price. Whereas you may be fearful and you want to make sure you have a little bit of insurance in case it drops. Somebody will buy that stock from you. So that's how it works on each side of the equation. And I exploit this to make outsized premium. Okay, let's go into the computer and I'm going to show you some real examples so that you can do this for yourself. To get started today, we are going to take a look at AMD. Now, they did have earnings after market today, but the option chains, they shut down at market. And so you're going to be able to see the elevated IV that was a part of the option chain today. It will look very different tomorrow now that earnings are over. But let's go take a look at, we're going to look at the 165 strike because that's kind of close to the action. And we're going to look at the expiration date of August the 8th. On my option chain in Tradier, it's listed right up here, IV, so you can get a good sense for the elevated IV. And if I look at that 165 strike, that's a 0.27 delta, and the IV is 1.07. So that's really high. So I'm going to compare that. That's a 0.271 delta. I'm going to pull up a different stock that doesn't have earnings and that's just not very exciting and show you the IV on it. Same expiration date. We're going to look at a similar delta, and I'm going to show you the IV. This is ticker symbol KO for Coca-Cola, and I'm looking right here at the 68 strike. Closest I can get is a delta of 0.19, and look at the IV. It's 0.19. It's so much lower than what you saw on AMD. And so I'm sure you're asking, so what is the average IV? How do I see what the average IV is, and how do I know if it's elevated or not? Well, for that, I go to a tool that is a free tool to use, and I'm not associated with them, but I want to show you how I go and find this information. This is on Market Chameleon, and like I said, it's part of their free version, so you don't need to buy anything to see this. But they have a little chart right here for IV, and I've got AMD pulled up, and you can see what the current IV is on AMD, and then you can look at how it compares with the average. But what I really like to do is read this right here. It tells you AMD implied volatility is 54.3, which is in the 85 percentile rank. This means that 85% of the time, the IV was lower in the last year than the current level. And then when you look down here, it says the current IV in AMD is 21.3% above its 20-day average. And so knowing that it's 21% above, when I'm going to take you to this new tool, you can adjust the tool to see how that is going to affect your option. Now, this is another tool I use. It's Options Strat. Now, I have the paid version, but you don't need the paid version to look this up. So what you do when you get here, you go ahead and put in your ticker symbol. I have it all populated, and you put in the strike price. We were looking at that 165. And right down here, it shows on this particular option, the implied volatility, and we saw that on the option chain, it's 108%. And so you can see right here, and you're able to move this backwards and forwards. So I'm going to show you something that's really cool. So this is paying $294. If I were to sell this put before the market closed today, I would have received $294 for this sold put. So let's assume that after earnings, that AMD just stayed right where it is, right there at 176. If that's the case, you would expect that all of these numbers would stay consistent. But because of IV Crush, they are going to be adjusted. And I'm going to explain it a little bit further. So what you want to do is go down here to this bar. And if we want to pull this thing down, let's just go ahead and pull it down to around 80% because we said it was like 21%. So let's get it down a little bit. Maybe we'll go up a little because it was 108. So as I'm moving this, you start to see these numbers changing. And what this is it's showing you how much of this 294 that you get to keep if AMD stays stagnant and does not move anywhere. This shows you how much you're getting to keep just because of the IV coming down. Now, they have a profit and loss percentage, so you can just click that on, and you can see that if it stayed right where it was when the market closed, you would still have 71% that you would get to keep of this 294. Now, of course, as price movement moves up or down, you can get a better sense for it. But even though price movement goes down, look, if it's going below where you sold that put at, you're still holding on to significant money, even though that the price is dropping after hours. So tomorrow, if you were to wake up and IB is down and this had dropped to 170, you still would be holding on to 26% of this option premium. Let's go take a look at how much that would be. So 170 right here. So you'd still have $80 just for the fact that IV dropped, even with the price dropping. So that's how powerful IV is. And this is why you want to be on the side of the trade where you're actually selling the option. So you're getting to take advantage of that IV. Because if you had bought this put thinking that it would go down, you would be really disappointed in how little money you actually get to keep from that trade. But me, on the other hand, I sold it. So I'm very happy with the amount that I get to keep. Now you are all ready to trade the next big earnings event or anytime you see elevated IV. It also works if the VIX is high due to fear in the market. Then it works just about across the board on every stock. So I'm happy to have shared this information with you. Remember, if you're with me, Trading with Ashley, there is no trader left behind. Now, just for fun, I am going to leave that video where I showed you exactly why I had so much confidence in Palantir that I put $1 million on the line to take that trade. You can watch that video right here.